Okay, I'm going to kind of breeze through chapter 10 here. Chapter 10 is all about liabilities. So we're going to talk first about current liabilities, which are liabilities due within a year or one operating cycle, but it's typically within a year. And then we're going to move into talking about some long-term liabilities and bonds a little bit. So study objective 1 is about current liabilities. That's what I just told you. Study objective 2 is about notes payable. This is just the other side of the transaction with note from notes receivable. This is when the company borrows money and has to pay it back. They're going to owe interest as time goes by. Um, Typical entry to record a note, see they're getting money and have to pay it back, and they're recording this payable. Interest has to also be accrued over time. You can see a situation here. You have an example where a company has to accrue interest for 4 months. There's the interest for 1 year calculation, and then you get 4 months by multiplying by this fraction. In this example, the maturity date is January 1st, so the very next day they have to pay off this note. So the payable goes away, the interest payable goes away, and there's the cash payment that's made. It's worth noting, though, that if this maturity date was like January 31st, there would be an extra month of interest that would have to be recorded, interest expense, that is. So if it was January 31st, this debit to notes payable would still be the same. The debit to interest payable would still be the same because that's just noting that the 4,000 from this year is being paid off. But there'd be a third debit for more interest expense of another $1,000. It looks like $1,000 a month is the interest rate, is the interest amount. So it would be another 1,000 of interest expense, and then the credit to cash would be 105. So um, kind of make note of that. Um, Study objective 3 is about sales taxes. We haven't really recorded this yet, but when a company makes a sale to a customer, they collect sales tax. You all know that from just shopping. So if it's a cash sale, a company will collect cash, debit cash. They'll credit sales for the amount of revenue they get to keep, but they'll also immediately credit a liability to the government for sales tax payable. So if the sales tax amount is known, I mean, if the problem gives you an amount of sale, and then you have to add sales tax to that, it's pretty easy to calculate the amount. But sometimes, let's see if there's an example here. It doesn't really say right here, but well, it does get into it down here. Sometimes the sales amount includes the sales tax. Like, what if this grocery store had sales of $10,000, but that included the sales tax number? Say the cash register can't, I don't know, break it out separately or whatever, then you would have to kind of root out the sales tax piece of the 10,000 that the store collected, because they're not exempt from paying sales tax just because their system doesn't show it separately. So to get the sales tax piece, you have to divide that 10,000 by, it's a 6% sales tax rate, so divide by 1.06, and that gets you the amount of the sales, the actual sales revenue, and then that amount times 6% would get you back to $10,000. Well, when you add them together, it would. So this discusses that right down here. Unearned revenues, we've talked about those before. That's when you receive cash in advance of performing your duty for your customer. So you get the cash, you record this unearned revenue liability, and then as time goes by and you earn the revenue, you debit away the liability and you credit revenue. Current maturities of long-term debt. Sometimes you have long-term debt that matures over time, and the piece that is due within a year does need to be recorded as a current liability, and the rest is recorded as a non-current liability. I'll continue in the next video.